Hi guys, okay, so we are going to check, okay, in our channel for a learning purpose, okay, about the NISM and also whatever they derived in the NISM book, okay, and we are going to check complete detail about this. So most probably if someone want to learn, okay, about this NISM series, so this will be helpful for you. And if you don't want to learn also, it will be helpful for you to understand what is the share market and how equity derivative markets work. This is what we are going to check in this series, okay. Most probably this all these concepts, okay, so all these concepts we are going to clear in upcoming videos, okay. In upcoming videos, this is what we are going to do it, okay. On daily basis we are going to upload a stock update as well as this, okay. So this is what we are going to do, and this will help you to improve your knowledge when it comes to trading and stock market and financial related instruments, okay. So this is what we are going to check. No, let's see what happened, okay. So let's understand whatever the things were there, and what is derivatives, what is future and forwards, options, all these things we are going to check. Now understand what is the derivatives, okay. Now let's understand what is derivatives. Basically derivative is a financial instrument. And so what you can do, okay, before I go through the video, what you can do, you can just keep it in your mind like a keyword, so that you will never gonna forget all those things, because basically I mentioned it like a keywords only. And this will help you to clear your exam in a NISM most probably, and this will help us understand what kind of things it will be, okay. So derivative is a financial instrument. Basically derivative is not asset, it is a financial instrument. So we all know what is instrument, correct. So it is basically derived from the value of an underlying asset, okay. So it is not a something, okay. So like for example, if you are seeing nifty 26,000 25,000, it is derived from top 50 stock. So what is underlying asset? Basically underlying asset is in the sense, okay, stock, bond, derivative or currencies are the underlying asset, okay. So what is derivation? Plus, minus, equal, okay, percentage, multiplication, divide, all these were derivation, okay. So the derivative instrument does not have an independent value. Why it does not have an independent value? Basically it is dependent upon the underlying asset, correct. So that number calculated from underlying asset, correct. So that is the reason it does not have an independent value. It is always dependent upon the underlying asset, okay. So derivative can be used either to minimize the risk, okay, or assume the risk with the expectation like kind of profit, okay. So you may have a risk and expecting the profit. So that is the reason derivatives can be used, okay. And let's check what are the types of derivatives we have in a financial market, okay. So forwards, futures, option and swaps, these four types of instrument, okay, we had in a financial market. So let us understand what is forward, okay. So basically forward is a contract, okay. This is a contract agreement between two parties, okay, either to buy or sell. If it is a contract, of course there will be a buyer and seller, correct, because basically that is how the contract works, okay. So buy or sell underlying asset in a future date, okay, not in a current date, future date for a particular price. So on this date of contract for the particular date as well, okay. So this is what you want to understand. So for example, me and you will make a contract in between you and me, okay, to sell a particular stock. Let's assume that 100 rupees worth of stock, and I am agreeing you to sell, okay, to you for 120 rupees on the end of October, okay, on the end of October. This is how it will work, okay. So this is how it will work. Basically forward and future will be similar, but you will understand what is the different also, okay. So basically this is the forward contracts are negotiated between two parties, okay, negotiated between two parties. Maybe you and me can negotiate, no, you want for a 119 rupees or you want for a 125 rupees, no, I will sell it only for 130 rupees. Like this negotiation can be happen, okay, in a forward contract, okay. And but okay, after this all this negotiation everything, we are committed to give a same stock, okay, irrespective of price changes, okay, or any differences. Then too we need to give the stock whatever the contract says, okay. That is what I mentioned it over here. Both of contract parties are committed or obliged to honor the transaction irrespective of price of the underlying asset at the time of delivery. whatever the price agreed on the contract, even the price variation. If I agree to sell on 120 rupees on the October end, okay, October end, I need to sell it for 120 rupees, even the stock price go to 150, 200 also. Okay, so forward contracts are negotiated between two parties in the over the counter. Okay, basically OTC we call over the counter. So it will happen in a over the counter. So this is not traded in a stock exchange. Okay, so basically forward contracts are traded in over the counter. Okay, and it is not trading in stock exchange. And what are futures? Okay, what is future? So future contract is similar to forward, as I told before. Okay, so this future deal is made through the stock exchange. So basically forward will be not traded in stock exchange and it is trading in over the counter. Okay, future contract were traded in the regulated stock exchange. Okay, and investor can use the future trading to, okay, speculate the price of the direction of asset. That means to say they can able to hedge against the price fluctuations. Understood? Okay, so basically they can hedge against the price fluctuation of the stock. Okay, investor can go for a long or short position. Long or short is nothing. Long is buy, short is sell. Okay, long is buy, short is sell. So basically they can go for a buy or they can go for a sell. If you are predicting that market will go up, you need to go for a buy. If you are predicting that market will go down, you need to go for a sell or a short. Okay, so basically future contracts were publicly traded on the exchange. This is not publicly traded on the exchange because this is the contract between only two parties, but this is publicly traded on exchange. And what are options? We all know what are options, correct? So because most of the traders were trading in the options, correct? So basically option contract that gives the right but not an obligation. Okay, you always need to remember this gives a right but not an obligation to buy or sell underlying on the before or started date at the stated price. Understood? Okay, so basically buyer of the option pays the premium. Okay, so basically buyer of the option pays the premium, or writer or seller of the option receives the premium. And we all know there are two type of option. One is call option, put option, because we gamble over here, correct? Call option, put option, we take call and we take put. Okay, so forget all those things, let's come for a learning. Okay, so call option and put option, there are two type of options. So we are going to make a other video same in a NISM series itself, what are options and how call option work, premiums were calculated, all these things you will get it in a upcoming videos. Okay, and let's understand what is swap. So basically swap is a derivative contract. Okay, this is also swap is also contract that allows two parties to exchange the cash flows or liabilities from the different financial assets over the specific period of time. Okay, so swaps can help to manage the interest rate risk and currency fluctuation and other exposures. Okay, swaps can be used to speculate on the future price movements or various financial assets. That means to say various financial assets, it may be anything like gold, silver, or different stocks. Okay, it can be anything, and swaps are traded in the over the counter market. Okay, it is not traded in the exchange, it is traded in the over the counter market. Okay, let's understand what is over the counter. Okay, so we all know earlier we used to go for a railway station. Okay, we give a currency to the person who is sitting in the counter, and instead of that he will give me a ticket, correct? Okay, so basically you are swapping the currency to get a ticket, correct? So this basically you are going to the counter and you are buying all those things, correct? So that is what over the counter. So this may be related to loan or bond, although the security can be almost anything. Okay, it can be anything. So I mentioned the example fixed deposit to loan. Okay, so basically some people, okay, they will put a fixed deposit and the bank will provide some other people as a loan, correct? Basically, and they will receive a interest. So still you want a more clear explanation. Okay, we all know gold. Okay, so you will go to like Manappuram, there are many financial things, correct? Manappuram, okay, Muthoot Finance, all those things were there, Bajaj Finance, even in your bank. Okay, you go, what you do, you will, okay, so you will give a gold to get some money, correct? You will give a gold to get some money. So that means to say you are swapping the gold for a money, correct? So this is what a swap says. Okay, in upcoming videos we are going to check whatever the option, whatever the future in detail. This is very simple concept. but we are going to check it in upcoming videos, and going forward we are going to upload one video in a NISM series for a learning. Okay, so this is what I want you to tell you, and thank you so much. Have a great day.